Gold is approaching a major liquidity zone right now, and smart money is quietly preparing its next move. So listen, forget the retail noise and emotional market commentary you're seeing today. My primary focus for this explainer is a highly probable sell setup resting right above key liquidity. But there's one specific algorithmic condition that absolutely must happen before we execute. Let's dive in and uncover exactly where institutions are targeting. Because here's the problem. Most retail traders are looking at the exact wrong level right now. They're out there desperately trying to catch a falling knife in a market that's completely controlled by bearish distribution. Today, we're prioritizing a strict institutional-grade sell setup. However, like I just mentioned, we're basically setting a trap for ourselves if we don't wait for the right structural trigger. There is a very precise sequence of events that has to unfold first. The algorithms are currently drawing price toward one specific institutional objective, and that's the 40-40 level. This is the macro sell-side liquidity target dominating today's entire structural narrative. Literally everything the market does between now and then is just engineering the liquidity required to deliver price to this exact level. Let's lay out today's executable blueprint immediately so you know exactly what we're looking for. Our daily bias, firmly bearish. The primary setup we are stalking is a short position, and our key liquidity targets are clearly defined. We're looking at the immediate session lows around 40.62, where early buyers have placed their safety nets, with the ultimate algorithmic draw resting heavily down at 40.40. So you know the objective. Now let's break down the institutional reasoning behind it. Looking at the macro level, the expansion is just undeniably bearish. We're witnessing a systemic downward repricing, printing consecutive lower highs and lower lows. Notice how price has violently broken through key structural demand zones without any hesitation. You know, this isn't just random market noise. This proves institutional order flow is methodically unwinding premium pricing. As we zoom into the shorter-term intraday structure, check out the perfect bearish alignment across the board here. Following a minor relief rally up toward the 41.40 region, price completely failed to establish higher highs. Instead, what did it do? It systematically swept internal buy-side liquidity and aggressively displaced downward. That heavy downward thrust is the unmistakable footprint of smart money actively accumulating short positions. So what's providing the fundamental cover for this technical delivery? Over the weekend, CENTCOM conducted airstrikes on over 300 Iranian targets, which reignited severe risks around the Strait of Hormuz. This sudden military escalation caused WT crude to jump above $74, and crucially, it triggered an immediate spike in the US dollar index as institutional capital sought a true safe haven. But this is exactly where the emotional trader gets trapped. Standard retail logic dictates that geopolitical tension in the Middle East means you absolutely must buy gold. The institutional reality, though, it's entirely different. Smart money is utilizing that incredibly strong US dollar to systematically engineer short liquidity. They're completely ignoring the retail safe haven impulse, absorbing that naive buying pressure, and distributing shorts right into it. With no high-tier red folder economic data during today's primary London and New York overlap, the algorithms need a different volatility catalyst. They're likely going to use the scheduled speeches from FOMC members Bowman and Waller. Institutions rely heavily on these specific events to inject sudden volatility, which allows them to rapidly drive price into targeted liquidity pools when the economic calendar is otherwise pretty quiet. Let's drop into our 15-minute execution model. Notice where price is right now. It's pressing hard against minor internal lows around 40.69.80, heavily extended into a micro discount array. Basically, it's already too cheap. Executing a short position right here is incredibly dangerous. You'd essentially be selling at the absolute bottom of the current curve, just providing exit liquidity to the institutions who are busy taking their partial profits. Which brings us to our precise, actionable plan. We never chase price. Step 1. We wait patiently for a retracement back up into the premium zone between 40.80 and 40.84, specifically targeting the fair value gap. That's our area of sudden, unfilled price imbalance. Step 2. Once we're inside that zone, we wait for a confirmed market structure shift lower. And step 3, only after we see that true downward momentum do we actually execute the short. Here are the strict parameters for today's institutional trade plan. The entry zone is precisely 40.80 to 40.84. Your stop loss absolutely must be placed at 40.93, resting safely above the recent structural swing high and the M15 order block. Our first take profit is the immediate session low at 40.62, and a final take profit is that major macro liquidity pool down at 40.40.
Now, professional trading requires absolute adherence to risk management. Hitting take profit 1 at 40.62 secures partial profits and moves the trade to break even. If price fully delivers to take profit 2 at 40.40, we capture a massive 1 to 3.5 risk-to-reward ratio. Keep in mind, an aggressive hourly close above our 40.93.50 invalidation level cancels the setup entirely. Based on the current order flow, we're assigning an 85% probability score to this sequence playing out.
But remember, the market is an active battlefield, and it rarely moves in a straight line. This is where smart money may create the trap. There is an impending false breakout scenario developing right before our eyes that most retail traders are completely ignoring. And it is specifically designed to separate impatient money from their capital, right before the real move happens. Take a look at the minor internal relative equal highs resting just above us, tightly clustered around the 40.85 to 40.90 region. This is engineered buy-side liquidity. We highly expect smart money to orchestrate a sudden, sharp rally during the London or New York session to sweep this exact area, intentionally triggering the stop losses of early, impatient sellers. This brilliantly illustrates the stark divide between retail impulse and institutional logic. The retail trap right now is either panic selling the absolute lows at 40.69 out of pure FOMO or blindly buying that curve extreme hoping to catch a reversal. The smart money strategy, on the other hand, relies on pure discipline. They're waiting for price to be drawn up into that 40.80 premium array, allowing the algorithms to sweep the weak hands, and only then stepping in to accumulate shorts. It's important to keep the broader macro perspective grounded here. While global central banks have structurally accumulated over 1,000 tons of gold for long-term reserves recently, our tactical intraday objective is entirely different. We're capitalizing on technical stop-loss cascades. An algorithmic drop toward 40.40 is simply a purge of vulnerable, over-leveraged long positions. It's not a fundamental regime change in gold's actual macro value. So let's do a rapid-fire final recap of today's blueprint so you are totally prepared. The overarching bias is strictly bearish. You must wait for price to retrace upward into that 40.80 to 40.84 premium array. Once it's there, demand confirmation via a clean M15 bearish displacement. If it's validated, execute the short and confidently target the massive sell-side liquidity pool waiting for us at 40.40. If you value consistent, institutional-grade market analysis utilizing ICT and smart money concepts, take a quick moment to subscribe to ICT Market Theory. And if you're looking to execute these precise setups in a professional, high-liquidity environment, you can find the FXTM account link provided in the pinned comment right below this explainer. I'm going to leave you with this critical question to monitor as the session volume really starts to increase. Will the upcoming FOMC speakers serve as the exact algorithmic trigger for that final liquidity sweep down to 40.40 today? Or is the market quietly engineering a much deeper premium trap to clear out all the early shorts first? Stay patient, adhere strictly to your trade plan, and trust the order flow.